In today's video, we're talking about aspects of the TSP that really aren't that good, and potentially they're a deal breaker and might make you want to move your money out. Coming up next. Hey, my name is Mel Stubbs. I'm here on behalf of Retirement Benefits Institute, bringing federal employees information on their system and how to retire, hopefully better from knowing this information. If you like this information, please subscribe. Please check out our website for other resources at retireinstitute.com. So I was scrolling through fedsmith.com the other day. It's a place that has a lot of information for federal employees. In fact, somebody from our organization, Brandon Christy, he writes, and he's an author there and puts a lot of information on FedSmith as well. But I landed on an article by Brad Bobb called Odd Aspects of the TSP. And we've done some individual videos on some of these aspects, but he kind of put them all together and it's like, man, this is good information. I need to share some of this and expound on it some. So shout out to Brad for this article. I want to take it a step further and say it might not just be an odd aspect of the TSP, it might even be a deal breaker where it might cause you to say, you know what, I don't want to be in the TSP anymore. So let's jump right into it. The first one is mandatory withholding. Now with mandatory withholding, when you take a distribution from TSP, they automatically make you take 20% out for federal taxes. They do allow you to take out more if you want to, but you cannot take out less than 20%. So for all the people out there in the 10% tax bracket or the 12% tax bracket, they're forcing you to withhold more money than you need to. Also, they don't let you take out state taxes. So if you're in one of the states that has a higher tax rate, and you take out a large distribution, you can't hold back any taxes for that, so that's kind of a pain. If you're in an IRA, you can withhold whatever tax amount you want. So the exact amount you need for federal, you can withhold. The exact amount you need for state, you can withhold. So you have a few more options in IRA world. The second aspect we want to talk about is distribution of your funds. You can't specify which, like the C fund or the G fund, you can't specify where they come from. Now I did a whole video right here where you can watch all about that specific aspect, but basically when you set up a distribution, it comes pro rata. Now you can specify it if you want it to be traditional or Roth. So check mark for TSP, you can do it that way, but you can't specify which investment you're in. So if you're 50% in the C fund and 50% in the G fund, when you take a distribution, it comes pro rata. Some people are using the bucket system where I've got a bucket of conservative money and that's where I want to take my distributions from, and I got a bucket of aggressive money. I don't want to take distributions from there. When the TSP, it doesn't let you be that specific. So what you would have to do is every time you take a distribution, you would have to reallocate your funds to kind of force it to do that, which can be a real pain. So is this a huge deal? It can be. In the other video we did, it looked at during the COVID time and when the stock market crashed, it did make a difference if you were forced to sell the stock market when it's lower. So it is kind of a big deal. The next aspect is a big deal, and it is required minimum distributions on your Roth TSP. So let's talk about IRA world for a second. You have to take RMDs, required minimum distributions, when you hit the age 72. And you have to take it from your traditional assets, so your traditional retirement accounts. Remember, this is money that you have not paid taxes on yet, and I guess the government wants their money now, so at 72 they force you to take some money out and you have to pay taxes. But with Roth IRA, they don't make you take money out. So it can stay there growing tax-free as long as you are living. So in the TSP, you do have to take a required minimum distribution on your traditional TSP, and that makes sense. But the problem is they force you to take a distribution on your Roth TSP. And you don't have to take one yet in an IRA and a Roth IRA. And so that can be a big difference. Let's say you're 72 years old and you're going to live to your 90. That's 18 more years that the Roth money can grow tax-free. Because when they force you to take it out with the required minimum distribution, you're either going to spend it or you're going to put it into an account that's taxable. So it can still grow, it's just going to be taxable instead of tax-free. This is a huge deal. You don't want to take required minimum distributions on Roth money if you don't have to. And in a Roth IRA, you don't have to. The TSP, you do. So that, to me, is a potential deal killer to want to move money out of the TSP. Now the next aspect I think is pretty big, and it gets confusing to say, so let me read it carefully. Beneficiaries of a beneficiary participant account can't do an inherited IRA. What does that mean in English? Well, think about this. When you're in the TSP, you are postponing. Let's assume your money is traditional, as the vast majority of people's TSP is traditional. You're postponing taxes for later. Now let's say you die and you leave the balance to your spouse. Let's say it's $500,000. Your spouse gets to inherit it. It can stay in the TSP. It can roll out to an IRA of some sort, and you still get to postpone taxes. Well, that makes sense. But now let's say your spouse dies and leaves the money to the next beneficiary. If you're still in the TSP, this next beneficiary is taxed into oblivion. What does that mean? You no longer get to keep it in TSP. Here's the technical jargon. If a beneficiary participant dies, for our scenario here, that would be your spouse, the new beneficiary cannot continue to maintain the account in the TSP. Also, the death benefit payment cannot be transferred. Cannot be transferred. You get me? It can't be transferred or rolled out into any other type of IRA or plan. It has to be withdrawn that year, and it will be 100% taxable if it's traditional money. So let's just say the average person's in the 22% bracket and they make $100,000 a year. They inherit the $500,000 TSP account. But instead of TSP, let's say it had been moved to an IRA. So they inherit the $500,000 IRA. Under the new rules, they have 10 years to get the money out. So what a lot of people do is they take out 10% of it every year for 10 years. Because when you take a distribution, it's taxable. So you don't want to do it all in one year. So let's say for simple math, you take out $50,000 a year, over 10 years you get it out. Now I know that doesn't account for growth and it need to be a little bit more than that, but just for simple math, you take out $50,000 a year for 10 years. So now when you do your tax return, your $100,000 income is now $150,000. I believe that still leaves you in the 22% tax bracket. Not a huge deal. But now let's say you left it in the TSP. You leave your TSP to your spouse leaves it in the TSP, and then they die, and the next beneficiary gets the $500,000, but guess what? They can't leave it in the TSP, they can't roll it over to an inherited IRA. So now the $500,000 is completely taxable all in this 1 year. So where they were making $100,000 a year and they're in the 22% bracket, for this year, now they're going to make $600,000 this year. If they have to take the whole TSP balance out in 1 year and it's all taxable, that is a huge tax burden. You have worked too hard to accumulate this money to foolishly mess up something with the taxes. You can plan better than this. So the fix to this is if you move your money out into an IRA, you die and you leave it to your spouse. They can either move it into their personal IRA because they're a spouse, or they can set up an inherited IRA. Now when they die, the next beneficiary person can set up an inherited IRA and they'll have 10 years to get the money out, not 1 year. This can be a huge difference. If you do the math, instead of paying 22% on $50,000 a year, they're going to pay 22% on some, 24% on some, 32% on some, 35% on some. They're going to pay a lot more in taxes, all because this rule kind of bit them. So you can plan around this by moving money out of the TSP. In IRA world, it's a lot easier to do what you're wanting to do. The TSP in this case just makes it too hard. To me, this is a deal breaker. Another aspect is the life cycle funds are overly conservative. So in the article, it shows that he looks up a 2040 fund, so like the TSP Life Cycle 2040 fund, but then he compares it to a BlackRock LifePath Index 2040, a Vanguard 2040 fund, and a Fidelity 2040 fund. And you can see here that the TSP is a lot more conservative than any of the other options. And so if you're not aware of it, you may end up being overly conservative and not meaning to. Now, can you get around this? Well, you can just not use the life cycle funds. And if you want to be more aggressive, then just go in and pick the individual funds to get around it. But, is this a deal breaker? Probably not. Is this inconvenient? Possibly. Now that you know about it, you can just individually pick the investments you want to achieve the aggressive conservative mix that you want. The next aspect is TSP won't allow Roth conversions. Now, we've done a video specifically on this as well. To me, this is another deal killer. Now, what is a Roth conversion? It is where you take traditional money and you switch it over to Roth. This switching or converting is taxable, but it ends up taking that money and moves it to be in a tax-free status. So for instance, you have $500,000 in your TSP. You take $50,000 a year and you want to move it to Roth every year to slowly but surely eventually have all of your money over to Roth. If you think taxes are going to be higher, then that would be something you'd want to do. The TSP does not allow it. If you want Roth TSP, all you can do is contribute to Roth, but you can't convert or switch money over. In an IRA, you can. So if you're 59 and a half or over, or if you've retired, you can move your TSP to an IRA. So traditional would go to traditional, and Roth would go to Roth, and that's not taxable. And then once you're in an IRA, you can look at your tax returns, look at your tax bracket, figure out how much you might want to move every year. This is something that if you want to do advanced tax planning, if you want to try to pay taxes now because you think now is cheaper than what it might be, you might want to do this. This option is not available in the TSP, and to me, this is a deal breaker. Check out the video if you want more information on this one aspect. So the last aspect is the TSP won't allow qualified charitable distributions, or QCDs. This is a way of giving money to charity, churches or charities, from your assets, from your IRA, from your investments. So instead of you just like writing a check from your checking account, you can actually give it from your assets. And by doing that, you can avoid some taxes. So the way the rules work is you can do it up to $100,000 a year. And once you hit age 72, when you have to take required minimum distributions and they force you to take the money out, up to the $100,000 a year, you can give that money away so it is not taxable. So what does this really mean? Well, let's just say that you tithe 10% to your church. Let's say $10,000 a year to your church. Right now, you have to earn money, put it in your checking account, then you give away $10,000. So for simple math, it might take you $13,000 of income. You pay taxes, you have $10,000 now, you give away $10,000. With this, you could give away $10,000 straight from your IRA once you're 70 and a half, and the church gets $10,000 and you didn't pay taxes on it, and the church didn't pay taxes on it. So there's two ways this might work. Let's say usually it takes you $13,000 of income to give away $10,000. Well, now you can give away $10,000 and it only costs you $10,000. So you could give the same amount but save money. Or if you want your money to support that church or charity even more, instead of taking $13,000 out to give $10,000, you could just give the church directly $13,000 from your IRA. So this qualified charitable distribution, it's not allowed in the TSP. This can be a big deal. If you are charitably minded and you want to give money away, there's a way to do it that is more tax efficient. The TSP takes that away from you and can't do it. So is this a deal breaker? Well, if you're under 70 and a half years old, it's probably not a deal breaker. But if you're over 70 and a half and you want to either give the same amount of money, but you save some money, or if you want to give even more money to have an even bigger impact, this can be a deal breaker for some people. So there you got it. Those are the 7 aspects of the TSP that kind of go from not ideal, they force you to take 20% tax withholding. That's not ideal. All the way to what I would consider would be a deal breaker. You can't do Roth conversions. To me, just my opinion, that's a deal breaker. Not being able to do charitable giving, if that's important to you, that can be a deal breaker. Forcing you to take RMDs on your Roth, deal breaker. And the big one that I think most people might not know about is that beneficiary. The third beneficiary is going to be all taxed in 1 year if you leave it with TSP. I mean, that's a big deal breaker to me. Now, are they deal breakers to you? Let me know in the comments. If you have questions about this type of stuff, if you want to talk to somebody about it, please go to retireinstitute.com, click on the Get Help, call the phone number on your screen. We would love to talk with you and help you in any way we can. My name is Mel Stubbs. I will talk to you next time.